Hello, everybody. Welcome back to Financial Options with Thumper. And today we're going to be talking about the option Greeks and why those are important for you to at least be aware on a basic level of how those work. So, first off, what are the Greeks? Well, the Greeks are a bunch of variables that give traders more information about how the price of a contract should behave depending on the movement of a stock or other variables. Uh, Knowing how you can expect your contract to behave will help you better create a trading plan, such as setting a profit taker or a stop loss, and have confidence in executing it because you understand how the price will fluctuate depending on like the movement of the stock or how IV changes. Some traders will use the Greeks as warning flags as to stay away from a trade because it might be too volatile and has the potential to really go against you. The most popular Greeks you'll hear talked about are Delta, Gamma, Theta, and Vega, with Rho maybe being fifth place consideration. There are a bunch of Greeks, but these are the ones that you should be at least aware of. At the end of this video, there'll be a screen that tells you what all these are. Take a screenshot, put it up on the wall next to you so you can see it whenever you need to. First off, delta. This is the expected price movement of an option contract based on a $1 increase on the underlying stock. So call options will have a delta between 0 and 1. If the stock moves up $1, the price of the contract should move up about that price. So like the delta. And if the stock goes down $1, you get the opposite. So if the delta was 0.7, you might lose 70 cents if the stock goes down. Put options are the same but opposite. So the value is between 0 and -1. This is because as the price goes up, you're winning your bet, so the contract goes down, assuming you sold the put. An example, if a call option contract on Thump stock has a delta of 0.7 and the price contract is $5 now, if Thump stock moved up $1 and everything else stayed the same, the option contract would now be worth $5.70. This is why I love setting up PMCCs, because at the delta of like 0.85 or 0.8 or above, when the price goes up, your leap is going to be capturing most of that upward movement. If you have 0.85 delta, it goes up 85 cents for a $1 movement in like the stock. So that's why when you set up PMCCs, you look for those higher deltas. Similar example, but using a put version. If you sold a put contract and it has a negative 0.7 delta, and the contract is 5, if Thumb stock moved up $1 and everything else stayed the same, the option contract would now be worth $4.30, because when the stock moves up, you add negative 0.7 to the price, which will bring the price down to $4.30. So calls, positive delta, price goes up, it goes up. Puts, negative delta, it goes down. Delta also has like a second purpose. It kind of tells you like the implied probability of being in the money. This is another way that traders use to help determine the approximate implied probability of a contract being in the money. An example of this would be if a contract is 0.3 delta, it has a 30% implied probability of being in the money. To quickly see what the implied probability of a contract would be, simply move the decimal over 2 spots and there's your percent. It is common for traders to drop the decimal when they're talking about delta. So if you see someone say they did a delta 30 contract, or sorry, a 30 delta contract, you would understand that means they did a delta of 0.3. And you can look that up in the options chain to see exactly what they put on. And the same thing goes with puts. Move the decimal, but get rid of the minus sign. So if I sold a put contract on Thump at 30 delta, this means that the put contract has a delta of negative 0.3, an implied probability of 30% chance to be in the money. Some generalizations: contracts at the money will have deltas closer to 1. They'll be affected more by the price of the stock moving than out of the money contracts. And contracts near expiration tend to have higher deltas than longer dated contracts at the same strike. Here's a little quick cheat sheet. Delta is quite simply how much the price will move up or down if the stock goes up or down. And deltas can also be used as the probability of being in the money. Next up is gamma. This is the rate at which delta will change. Think of delta as the speed that the price will change, and gamma as you putting your foot on that accelerator pedal It's the acceleration that price will change going forward. A little example here. If you had a $3 stock with a 0.5 delta and gamma was 0.1, if the stock price moved up $1, delta would move up to 0.6 as a result because the gamma was 0.1. So this is how you can see that the delta will continually move as the price fluctuates as well, based on what the gamma of the contract is. Just like delta, gamma is typically higher for options near an expiration. If gamma is high, a change in price can accelerate your gains or losses pretty quickly. Some traders will close out contracts to reduce gamma risk because if it starts going against you, they know gamma is going to accelerate and make it move even faster against you. Theta increases if the contract becomes near expiration. And it's because when you sell a contract, it's just marching down to its expiration. And once it gets down to that day of expiration, the only value left on that contract is going to be intrinsic value. All the time value is going to be out. So as it gets closer to expiration, theta might have to be higher, burn off that extra value in order to make the option price reflect the intrinsic value that's left. Theta is highest for the contracts at the money because those are the contracts that have the highest amount of time value in premium. So if you've never seen this, this is a theta time decay chart, and it shows you how longer dated contracts will lose less value from theta than contracts that are nearing expiration. And this is why you hear people say that they usually trade 30 days out, because this is where you see that highest acceleration of theta, where theta gets at its peak and just wipes out, eats at the value quickly. Out of money contracts are marching to zero when they are put on. So at first this will happen slowly, but as the day comes up, it picks up speed because it's now racing to get to that real value. And then people will sometimes talk about weekend decay. There's research supporting both sides. I think it's kind of like the question of, is a hot dog a sandwich? We'll never really know the answer. I think the research shows that weekend decay is not a thing, but when I'm putting on my contracts, it sure does seem like premium gets sucked out over the weekend. Back to the cheat sheet here. Time decay, just how fast the contract's going to be losing money due to time. And Vega is the amount option prices will change for a 1 point change in implied volatility. What's volatility, you say? Well, it's the amount that the stock fluctuates without regard for direction. So in this little picture here, if this was the hypothetical historical implied volatility for two stocks, you see they both ended at the same point, but the blue one moved a lot more than the red one, so it would have higher volatility, making it riskier as an options seller, so you want to get more premium to take on that risk. So, typically, as implied volatility increases, the price of contracts increase. This affects the time portion of the contract, thus longer dated contracts usually have a higher Vega. Keep in mind, implied volatility changes quicker for near expiration contracts compared to longer dated contracts, so Vega can change really rapidly in the last couple weeks. This is why some people like Tasty Trade videos will say they close 2 weeks out in order to reduce Vega and gamma risk. And then here's the final cheat sheet for the Greeks. I'm going to turn off my camera. And RHO, or rho, is just how much the contract would change for a 1 point change in interest. For your shorter dated contracts, that doesn't really matter to you. But if you're doing longer dated contracts, that might become an interest.
I am not a financial advisor. Any information included in this video is for informational and entertainment purposes only. It is not intended to be investment advice. Please seek a licensed professional for investment, tax, or legal advice.